This is not financial advice. I'm recording my thoughts about SentinelOne, which is a cybersecurity company. This company competes with the likes of CrowdStrike, Microsoft, McAfee, etc., which are also very good companies. When I look into the stock price of this company, it's currently trading at about $24 with a market cap of about $6.8 billion. But when I look into its revenue for the past 12 months, they made about $250 million, which represents a price to sales of about 27, which is extremely expensive. Whenever I see these high price to sales companies, I always research a little bit to see if there is anything special about this company, if they are unrivaled and if they have any unrivaled product that they can conquer the market with. But I didn't find anything special about SentinelOne compared to its peers like CrowdStrike and Microsoft. So this is just another company in the cybersecurity space that's trying to get market share. In fact, CrowdStrike has been saying that SentinelOne is not end-to-end like them. So SentinelOne just made an expensive acquisition of Attivo Networks for about $616 million. So now they are an end-to-end security solution. So we'll see in future how they're going to grow their business and gain market share. When I look at the net income for this company, it's about minus $300 million. So this is a growth company just starting out, so it's okay to lose some money, right? Because we are assuming that it's going to make a lot of profit in future. But when I look into the number of outstanding shares, they're standing at about 277 million, and I got really concerned because last year they only had 177 million stocks. So that is extremely high dilution, which is going to hurt the stockholders, and I don't know anybody is noticing this or not. So now let's look into the growth rates. This is a very small company that is making only $200 million of revenue in 2021, right? So they're growing in triple digits, like 100% growth year on year. And even in the past few quarters, they grew in triple digits. But as they grow bigger, it's not easy to double your revenue all the time, right? For reference, CrowdStrike is 7 times bigger than SentinelOne, and they are only growing at about 60% now, right? So over a long period of time, this triple digit growth is not at all sustainable. In fact, their growth rate should decelerate in the coming years because they don't have any special product compared to their peers. So the big question now is, can I invest in the stock at $24 price tag, right? So for that, I need to have an evaluation into the future in next 2 to 3 years to see if this company will make good enough net income. So I'm going to assume 75% growth rate, which I think is optimistic for this company for the next 4 years. They would make about $2 billion of revenue. When I look at their gross margins are in the 60 to 70%. So I'm going to assume 25% net profit margin. So with 25% net profit margin, they would make about $0.5 billion of net income. This kind of company that's growing at 75% and has a net profit margin of 24%, I can assume a multiple of 27.5 or so, but I'm going to assume a generous multiple of 30. So with a generous multiple of 30, they would be worth about $15 billion or $54 per stock in 2025 December. So that's about 2x reward, right? So I'm playing for a 2x reward, but the risk is that this company has nothing special, right? Their product is not unrivaled, and they are just competing with other great companies in the same sector, and they're diluting the stock significantly, hurting us shareholders. The stock-based compensation is sky high. It's growing, so they're growing the revenue at 100%, but the stock-based compensation is growing at 130%. So these are all red flags for me. Maybe this company will be successful, but at the moment I'm playing for 2x reward and the risk is huge. So I'm going to stay away from companies like this.